Hey, this is Wayne Wagner with Market Vision. Today on Market Vision, we're going to completely geek out on SPACs. So what is a SPAC? SPAC, S-P-A-C, is a special purpose acquisition company. This business model was created by the regulators, but created by Congress about 50 years ago, and it's been this little arcane part of the marketplace where maybe a few $100 million a year would be raised in this market. And basically what it was generally an investment company that had an idea of a company or a sector that they wanted to get into, and so they would go raise money from investors. It would be a publicly traded shares. So basically sell the shares through an IPO type process for about $10 a share. And then, and there's literally nothing in the business entity. Sounds a little scary, sounds a little Ponzi scheme-ish, but it is actually legal. So they would go raise the capital and then they would go acquire a company. And the prospectus usually gave them 12 to 24 months to go acquire a company. The reason SPACs are coming up and the reason you may have seen them over in the marketplace and the media over the course of the last couple of years is because this little arcane part of the marketplace that was raising maybe a few $100 million a year, in 2019 all of a sudden raised like 14 billion in new capital. In 2020 it was like 75 billion. First quarter of 2021, over 80 billion in money raises announced already, and people like Derek Jeter and Colin Kaepernick now sponsoring the money raises. So now not only are they raising money, they're getting celebrity spokespeople to help them raise the money. So all of this sounds a little strange, but because there's a lot of capital flowing into this little arcane business structure that's been around for 50 years all of a sudden. But there's a reason for this. The reason for it is that over the course of the past 15 years, really since 2008 crash and all of the excess regulation that came down on Wall Street flowing out of that crash, companies have started to access, privately held companies have started to access private equity, venture capital, angel capital investing, and they have figured out how to stay private longer. Because remember, the reason that companies go public is to create liquidity for their existing shareholders and access capital in the marketplace. So sell shares out of the company vault into the marketplace to be able to get renewable capital, get more capital into the company so they can continue to expand. That's why companies typically go public. Companies have been able to utilize the private markets far more effectively, and those private markets have become far larger and far more robust. So companies have been able to delay when they go public, and there's a lot of data, a lot of things that back this up, that companies have been waiting as much as a decade longer on average to go public. Well, now there's a lot of companies who are in that, and we have a healthy market, obviously, bouncing around all-time highs, and there's a lot of companies who would maybe like to go public, but going IPO in a hot market, in a crowded market, is a lot of work. It's expensive. The compliance costs are very high. Anything that CEO says that's just a touch off can get him and the company sued. And so there's lots of reasons why companies kind of shy away from that IPO market. They don't necessarily want to go through the rigmarole of all the dog and pony shows and so forth to go IPO. Enter the SPACs, because rather than doing all the dog and pony show and trying to find all these institutional investors, if you're a company that wants to go public and you can find a SPAC, and you can bring your two companies together, wow, you can create magic perhaps. So the thought process is you go find a company, you have a SPAC that you merge with. The SPAC is already publicly traded. So this is a simple way for a company to go public without having to go through the IPO process. And rather than negotiating with all of these institutions about what the share price should be, you're only negotiating with one company. It's the SPAC and the SPAC management company. So the SPAC has gone out, raised capital from individual investors with a timelines, typically 12 to 24 months to raise that or to get a transaction done. So they've got the pressure to get a transaction done in a certain time frame, and you are negotiating with one entity, one business, instead of dozens or hundreds of different institutions. So that's why all of a sudden we have this intersection of the need for capital, need for an easy way to go public, and a SPAC starting to raise capital. That's where we're getting the intersection of these two businesses at this moment in history. Now, with tens of billions of dollars going into an area of the market that used to only handle a few $100 million a year, it's going to create some speed bumps. There's going to be some things here. So to put things in perspective, it used to be that typically 20 to 40% of the SPAC money that got raised didn't get to a transaction. Like, they didn't find a company to actually execute. Last year, that number was 0. Everybody that raised money in a SPAC got a deal done and went full cycle and merged with a company, acquired a company, and is now moving forward. Mixed results. These companies were all over the place in terms of what their performance after that merger, after that acquisition transaction is, but 100% transacted last year. SPAC money is piling up at this stage, and so we would expect that there's going to be a lot of transactions done over the course of the next 12, 24, 36 months. With the amount of capital that's come into that space in the market, we're going to see a lot of this. So this is more an educational video, something that we're geeking out on, something that we're digging into, trying to figure out which ones of these organizations will be winners or losers. There's companies like Lucid Motors, which is going to be an electric vehicle competitor to Tesla. Seems to be a fantastically run company with a great product. It's not an investment recommendation, but that's going to be, they're valued at like $24 billion. And so that SPAC transaction where they go public, that's going to be an interesting one for people who want to enter the electric vehicle market for them to keep an eye on, right? There will be inevitably, there are going to be some bombs here. There are going to be some dogs here. We don't know where they are or who they are. We're trying not to get too deep into this, not go off the deep end. As always, here at Visionary Wealth Management, if you have questions, reach out anytime. We're always here with perspective for the decisions ahead. I hope you're having a great week, and I hope I didn't bore you to death on SPACs today. Take care.